So how would one's credit affect them getting a mortgage?
So credit is a huge component of qualifying for a mortgage. There's three main ones: credit, income, and down payment or assets, right? So the credit aspect, as a lender, just think of it this way: if you're giving someone $500,000 to purchase a house, you want to know that they have the ability to repay it on time. And by looking at their credit report, you see their credit history. Have they had any late payments in the past couple of years? Have they had anything go to collections? Have they gone bankrupt? Consumer proposal? What's their credit score? How many credit cards do they have? So it's a lot more than just the score. The score is just the tip of the iceberg. When we pull the report, we look at the entire package. I've had clients, for example, who've had a 780 score, but the bank said no. And you might be asking, well, how could they say no, 780? Yeah. They had such limited credit history. They had one phone bill with Rogers, and that's all they had. They didn't have a credit card. No one ever teach them about credit. So because they had nothing negative on the report, their score was actually high, but it's what we call a thin report. There was no actually history. So we had to substitute, and we got some like bank statements that shows they're paying rent on time. We got a letter from their landlord to, because usually they want to see at least 2 accounts, but credit's huge. Like I can go on talking a while. I don't want to.
So like for credit, if someone is making like $200,000-300,000, that's what you need right now to buy a house, basically.
In Toronto,
yeah, a year. Now, if the credit is like 650,
yeah,
is that something that's workable?
Good question.
Right, like because you have low credit but high income.
Yeah,
but maybe your debt ratio is high. You made a couple late payments on your credit card, all that.
Each bank has a minimum credit score threshold. Technically, for a bank like Scotiabank, their minimum is 650, right? That doesn't mean if you have 650, they're going to approve you. It's circumstantial. They have to take a look at your report. So if it is a lot of late payments, at the end of the day, we have to justify to the bank. We have to say, well, why did Mr. Smith have this issue 1 year ago and he was making late payments? And where is he at now? If we can show other aspects of the file, like he has super strong income, he's borrowing at not even near his maximum, he has a good amount of assets, then if one aspect is a little bit lower, but the others are better, then we can present that to the bank and get an approval. So is it possible? Yes. It really just depends on the overall file. But from an A lender, the minimum you want to be is 650, ideally 680 or higher.
Okay. Yeah. Now, go ahead, sorry.
No, I was just going to say, just like, I've learned a lot about actually credit this past year because before I made the mistake, I had some loans coming out of like university, stuff like that. And, I thought just if you pay everything off right away, that's going to like boost your credit.
Right.
And I wasn't carrying like any debt at one point. And my credit score actually went down.
Yeah.
So I was like,
hold on, your credit score went down when you paid everything off?
Because I had nothing.
Yeah.
I had no credit card at that point, nothing. And then my credit score went down and I was a little bit confused. I was wondering, how does that happen? How does that make sense? Right?
Yeah. That's a solid point. And you wouldn't believe how common that is from clients, friends. They think, okay, I have debt, pay everything off. That should be good, right? No debt.
That's what I'm thinking too.
I guess you just want to keep some sort of balance, keep it under the 30%. Is that what it is?
There's a few different categories that make up your score. Okay, one is diversity of credit, which means how many different accounts can you responsibly maintain. It's not a bad thing to have many credit cards as long as you maintain them responsibly. So ideally, you want to have maybe 1 or 2 credit cards, a line of credit. You don't have to have an auto loan, but if you do, then that potentially can help. Don't go out and get one just for this. But you want to have at least 2 accounts, with at least one of them being what we call a revolving account, like a line of credit or a credit card. If you just pay everything off and make the mistake of closing that account,
that's what I did.
Then, you have an inactive report. So, really? It's better than having a bankruptcy, but it's worse than having an active credit card that even if you don't use it, it potentially helps. So